Well, we think it's going to surprise today with the repo rate cut. On the face of it, it does look like a dilemma because of higher inflation and slower growth. But if you look between and read between the lines, the higher headline inflation is actually a thing of the past. The forward inflation trajectory is looking a lot more benign. And even in this uptick in inflation, it was almost entirely driven by things like vegetables and gold, whereas the core momentum, the trim mean, is actually running below the central bank's 4% midpoint target, I would say, for over 9 months now. Whereas if you look at the growth signals, they've been softening for 6 months now. And while October was better than expected, the high-frequency data for November actually looks soft again. So the expected rebound in growth does not look like it's going to sustain. So we think actually there isn't that much of a dilemma, and which is why we think there'll be a surprise cut today.
Indeed, do you think that maybe even the RBI could launch into a deeper easing cycle than the market is currently expecting?
That is indeed our base case. I think the essential thought process here for us is that the growth downturn is likely to last longer and is going to be deeper than what the central bank is estimating. So RBI is expecting growth this year to be at 7.2% and next financial year at 7.1%, whereas our forecasts are at 6% and 5.9% respectively. So the extent of growth hit is substantial, and India's potential growth is around 6.5% to 7%. So if you're growing at 6%, that's a fairly sustained period of below trend growth. And as I mentioned, the underlying measures of inflation have already converged to 4% and below, and we don't actually see much signs of second round effects. So our estimate, therefore, is RBI is going to cut rates by a total of 100 basis points. We have the terminal rates coming down to 5.5% by middle of 2025.